Starting a business is an exciting endeavor, full of possibilities and the potential for great reward. But before you leap into the world of entrepreneurship, it's crucial to lay a strong foundation. This starts with understanding the different legal structures you can choose for your business. The legal form you select will impact many aspects of your company. These include your liability, how you pay taxes, and even the ease with which you can secure funding. In this guide, we'll explore the most common types of business structures, highlighting their advantages and disadvantages. Understanding these fundamental legal forms is the first step towards building a successful and sustainable business. Take the time to carefully consider which structure aligns best with your vision, goals, and risk tolerance. The right foundation will provide the stability and support you need to thrive in the competitive world of business. For many entrepreneurs, the journey begins with a simple idea and the desire to bring it to life. The simplest and most straightforward legal structure for a new business is the sole proprietorship. As the name suggests, a sole proprietorship is owned and run by one person, and there is no legal distinction between the owner and the business. One of the most attractive aspects of a sole proprietorship is its ease of formation. There are minimal legal requirements, making it an appealing option for solopreneurs eager to get their businesses up and running quickly. In addition, the owner has complete control over the business and directly receives all profits. However, the simplicity of a sole proprietorship also presents its most significant drawback. The owner is personally liable for all business debts and obligations. This means personal assets are at risk if the business incurs debt or faces lawsuits. While the simplicity of a sole proprietorship can be initially appealing, it's essential to weigh the risks carefully. As your business grows, you may want to consider transitioning to a different legal structure that offers greater liability protection. When two or more individuals come together with a shared vision to start a business, they often form a partnership. In a partnership, the partners share in the profits, losses, and management responsibilities of the business. Partnerships offer a simple and flexible way to combine resources, expertise, and capital. They are relatively easy to form, typically requiring only a partnership agreement outlining the rights and responsibilities of each partner. However, like sole proprietorships, partnerships expose partners to personal liability for business debts and obligations. Disagreements among partners can also create challenges and potentially jeopardize the business. There are several types of partnerships, each with its own implications for liability and management. It's essential to consult with legal and financial professionals to determine the most suitable partnership structure for your specific needs. Corporations represent a distinct legal entity separate from their owners, known as shareholders. This separation offers significant advantages in terms of liability protection. Shareholders are generally not personally responsible for the debts and liabilities of the corporation, shielding their personal assets from business risks. Corporations have the ability to raise capital more easily than other business structures, primarily through the sale of stock. They can also attract and retain talented employees by offering benefits such as health insurance and retirement plans. However, forming and operating a corporation is much more complex and expensive than other business structures. Corporations face stringent regulatory requirements, including corporate taxes and extensive record keeping. Despite the complexities, the benefits of limited liability, enhanced capital raising capabilities, and perpetual existence make corporations an attractive option for many businesses, particularly those operating on a large scale. Section 5, Limited Liability Companies, the best of both worlds. A limited liability company, or LLC, is a hybrid business structure that combines the liability protection of a corporation with the flexibility and tax benefits of a partnership or sole proprietorship. Owners of an LLC are called members. Like corporations, LLCs offer limited liability protection to their members, safeguarding their personal assets from business debts and lawsuits. LLCs also offer flexibility in management and taxation. Forming an LLC is more complex than a sole proprietorship or partnership, but simpler than a corporation. LLCs face fewer regulatory requirements compared to corporations, offering a balance between legal protection and administrative burden. For businesses seeking the liability protection of a corporation without the complexities and tax burdens, an LLC often presents an ideal compromise. Section 6. Mergers and acquisitions. Joining forces in the business world. As businesses grow and evolve, they may engage in mergers or acquisitions to expand their market share, acquire new technologies, or streamline operations. A merger occurs when two companies combine to form a new entity. An acquisition happens when one company takes over another existing company. Both mergers and acquisitions can be complex transactions requiring extensive legal and financial due diligence. Mergers and acquisitions can offer significant benefits such as increased market power, economies of scale, and access to new resources. However, they also present challenges, including cultural integration issues, regulatory hurdles, and potential conflicts between the merging entities. Careful planning and execution are crucial for successful mergers and acquisitions. It's essential to seek guidance from experienced legal and financial advisors throughout the process. Section 7. S-Corp and non-profits tailored business structures. Beyond the four main business structures, other options cater to specific needs and objectives. An S-Corporation, or S-Corp, is a special tax designation. S-Corp allow businesses to pass corporate income, losses, deductions and credits through to their shareholders for federal tax purposes. Non-profit organizations, as their name suggests, operate for purposes other than generating profits. These organizations focus on charitable, educational, religious or other public benefit missions. They enjoy tax-exempt status, meaning they're not subject to federal income tax on their earnings. Choosing the right legal structure for your business is crucial. Consider your long-term goals, risk tolerance, and desired level of administrative burden. Consulting with legal and financial professionals can help you make informed decisions that align with your business objectives. Section 8. The business plan, your roadmap to success. A business plan is a written document that outlines a company's objectives and strategies. It serves as a roadmap, guiding the company's growth and development. A comprehensive business plan should include sections on the company's mission and vision, products or services, target market, marketing and sales strategies, management team, financial projections, and funding requests. Each section of the business plan plays a vital role in communicating the company's story to potential investors and lenders. The mission and vision statements articulate the company's purpose and long-term aspirations. The products or services section describes the company's offerings and their value proposition. The target market analysis identifies the specific customer base the company aims to serve. Marketing and sales strategies outline how the company plans to reach its target audience and generate revenue. The management team section highlights the experience and expertise of the individuals leading the company. Financial projections provide a realistic assessment of the company's expected financial performance. Section 9. Understanding financial fundamentals. Understanding key financial concepts is essential for making informed business decisions. Two crucial concepts are fixed costs and variable costs. Fixed costs remain constant regardless of the volume of goods or services produced, such as rent or salaries. Conversely, variable costs fluctuate with production levels like raw materials or shipping costs. The break-even point is the level of sales at which a company's revenue equals its total costs, meaning it is neither making a profit nor incurring a loss. Break-even analysis helps determine the number of units or the revenue required to cover all costs. Net profit, also known as net income, is the company's total revenue minus all expenses, including taxes. Understanding net profit is crucial for assessing the overall profitability of a business. By grasping these financial fundamentals, entrepreneurs can make more informed decisions about pricing, production levels, and overall business strategy.